Hey there, money mavens! Let's talk about risk. You know, that scary thing that can make or break your portfolio. Turns out, people have been trying to tame risk for centuries. Way back when, ancient civilizations like the Babylonians had some tricks up their sleeves. They used something called bottomry. This was basically an early form of marine insurance. Merchants would get loans for their voyages. If the ship went down, the loan didn't have to be repaid. Pretty smart, huh? Fast forward to ancient Rome, and we see the rise of something called collegia. These were like guilds for different professions. They provided a safety net for members. If a member hit hard times, the collegia would help out financially. They even covered funeral expenses. It's all about sticking together and spreading the risk, folks. These ancient practices were the early building blocks of risk management. They understood that protecting yourself from the unexpected was crucial for financial survival. These early risk tamers were onto something big. They knew that planning for the unexpected was key to financial success. And guess what? That same principle still holds true today. Whether you're a Babylonian merchant or a Wall Street tycoon, managing risk is the name of the game. Let's fast forward to the Middle Ages. Trade was booming, but it was a risky business. Ships were at the mercy of storms, pirates, and all sorts of other dangers. That's where maritime insurance came in. Merchants would pay a premium to transfer the risk of loss to someone else. It was a way to protect their investments and sleep a little easier at night. Another important development during this time was the rise of mutual aid societies. These were groups of people who pooled their resources to help each other out in times of need. They were like the ancient Roman collegia, but on a larger scale. These societies provided a safety net for their members, offering assistance with everything from medical expenses to funeral costs. The idea was simple. By spreading the risk among a larger group, everyone was better protected. Hold on tight, because the Industrial Revolution brought some serious changes to the risk management game. With factories popping up like mushrooms, new risks emerged. We're talking about workplace accidents, fires, and all sorts of industrial disasters. This is where modern insurance companies stepped up to the plate. They developed new types of insurance policies to cover these emerging risks. These companies used statistics and actuarial science to assess risk and set premiums. They became more sophisticated in their risk management practices. This period also saw the rise of government regulation in the insurance industry. Governments recognized the importance of insurance in promoting economic stability. They began to introduce laws and regulations to protect consumers and ensure the solvency of insurance companies. Risk management was becoming more formalized and essential than ever before. Now, let's zoom ahead to the 1970s. This is when financial risk management really took off. The world was becoming increasingly complex. New financial instruments were being created. Globalization was connecting markets in ways never seen before. Companies and investors needed new tools to manage the risks associated with these changes. One major development was the use of computer models to assess and manage risk. These models allowed financial institutions to analyze vast amounts of data. They could identify potential risks and develop strategies to mitigate them. The 1980s and 1990s saw a wave of financial innovations, such as derivatives and securitization. These new instruments offered exciting opportunities for profit, but they also introduced new complexities to the world of risk management. The Asian financial crisis of 1997 to 98 was a wake-up call. It showed just how quickly financial shocks could spread in our interconnected world. It highlighted the critical importance of sound risk management practices. Today, risk management is more important than ever. The financial world is constantly evolving. New risks are emerging all the time. From cyber attacks to climate change, the challenges are significant. But by learning from the past and embracing innovation, we can navigate these risks and secure a more prosperous future. Stay tuned, folks.